a session on the fundamentals of GST from a non-finance professional's perspective. So we are not going to delve into complex details, which will take a lot more time, and we can absolutely respond to more detailed queries that you may have as a result of this session through email or telephone calls. But this is more an introduction to GST for non-finance professionals, business owners, functional, leaders who want to understand how the current regime and the future regime are going to be different, and what kind of impact it is likely to have on the day-to-day lives of businesses, especially in the amongst the small and medium enterprises. Before we get into the details of this session today, I just wanted to introduce my colleague, Raman Murarka. Raman Murarka is a qualified chartered accountant with varied experience of working both in the manufacturing as well as in the services sector. Raman has worked extensively on indirect taxes and is currently leading Lexplosion's consulting initiative with regard to GST implementation. Prior to joining Lexplosion, just before this, Raman used to work for the Polar Group. Since Raman is a chartered accountant, I thought it will be more appropriate, instead of me taking you through it, because there will be a non-finance professional taking a session for non-finance professionals. I thought it would be better if a finance professional can take the session and explain the nuances. I'll be with Raman through the session and will be very happy to get into specific areas and of course answer any of the questions that you may have at the end of the session. So just to introduce the concept, we are talking, as you all probably know, at least this I'm sure most of you are aware, broadly the tax structure is divided into direct and indirect tax. Today's session is with regard to indirect tax, which is both the taxes levied by central government as well as state government. With that, I will now like to pass on the session to Raman. Raman, it's all yours. Please introduce and start.
Yeah. Hello everyone. This is Raman Murarka speaking this side. So with respect to GST, let us first understand what is the present tax structure in India. The present tax structure in India has been segregated into two parts. One is the direct tax. We all know that, as the name suggests, direct tax is a tax which is leviable on the income and wealth of an individual, and the incidence of direct taxes cannot be passed on to other persons. However, in case of indirect tax, this tax is to be paid indirectly by every person, and the incidence of the same can be easily passed from one person to another. Say, manufacturer can easily pass the incidence to distributor, distributor to retailer, and retailer to ultimate consumer. So, with respect to indirect taxes, there are certain taxes which are levied by central government, and there are certain taxes which are levied by state government. So with respect to the taxes that are levied by central government, that is excise duty, service tax and customs. Excise duty is a tax which is leviable on the manufacture of excisable goods. Custom is with the implementation of GST, there will be no change in the income tax and custom structure under the proposed GST Act. Only excise duty, service tax, entry tax, luxury tax, VAT, CST and many other state taxes will be subsumed. So with respect to the service tax, this is basically payable on the taxable value of services provided, and entry tax and luxury tax is again subsumed under GST. So now let's come to the detail of the summary of excise duty. Excise duty, as we have discussed, is a tax or leviable on the manufacture or production of excisable goods. And since this is an indirect tax, so this is paid by the manufacturer. However, the incidence of the tax has been shifted to other persons, and finally it has to be borne by the ultimate consumers.
And what we would like to highlight is why we are talking about the existing tax structure is, without understanding the complexities of the current structure, it will be difficult to appreciate how GST is going to make a significant difference in the way the whole indirect tax regime is going to change for all of us involved in various types of businesses. Coming specifically to this particular slide, if you look at the concept of excise duty, this is only applicable through the production and manufacturing process. So the moment a good leaves the manufacturing process into the distribution or sales process, excise duty is no longer chargeable, nor can any credit or debit be sought for excise duty. It is only something that is available in the production and manufacturing process, as opposed to, say, for example, value added tax, which Raman will cover.
With respect to value-added tax, this is a tax which is applicable for every dealer who carries on the business of sale and purchase of goods, and value-added tax is to be payable in case of sale and purchase of goods within the same state. However, in case of sale and purchase of goods from one state to another, then the central sales tax come into picture. And entry tax, as the name suggests, is a tax which is leviable on the entry of goods in any particular state. Presently, there are certain states in which entry tax is applicable in India. And luxury tax, as the name suggests, this tax is a tax which is not deemed to be to be essential, and accordingly, this is leviable on the luxurious items only.
So just since we are not absolutely sure about the background of our colleagues who have joined the session, I think what might be interesting is to also understand that for most of these taxes, if you look at the service tax or excise duty or VAT, it's a part of a value chain. So it's not like the tax just gets incrementally added through the entire manufacture or service delivery process. So if you are providing manufacturing something, and in the process if you are buying certain raw materials, and if you are paying a certain amount of excise duty or a certain amount of VAT, then in some of the cases you can actually take credit for it. And so when you actually have to file taxes, you can subtract what you have paid for in terms of these duties from what you have charged to your customer, and then pay the balance to the government. So that is it is an important part of indirect tax, and that is where it is fundamentally different from the direct tax regime.
No, with respect to the existing taxes that will get impacted on the GST, this has been segregated into two parts. One is the taxes that is levied presently by the central government, that is central taxes, and the another one is the state taxes. Central taxes includes central excise duty, additional duty of excise, additional duty of custom, excise duty levied on medicinal and toilet preparation, then service tax and other surcharges and cess that is leviable by the central government. With respect to the state taxes, the taxes that will be impacted under GST includes local state VAT, central sales tax, purchase tax. As we all know that purchase tax is a tax which is leviable when we are purchasing any goods from the unregistered dealer. So then the purchase tax come into picture. Then there is an entertainment tax which is not levied by the local bodies. Then entry tax which is leviable on the entry of goods, and similarly octroi. Octroi is presently applicable in Maharashtra. It is commonly known as octroi in Maharashtra. With respect to the luxury tax will also be subsumed. So all the taxes under the proposed GST regime will now be based on the various rates that may come into picture. The luxury tax will be replaced. Then the taxes on lottery, betting, gambling, and the various surcharge and cess that is presently levied by the state government will also be replaced with the implementation of GST.
So what we need to understand is that, for example, now there are cesses and surcharges, things like 1% surcharge for education, or education cess, or a Swachh Bharat cess. These are all levied on top of the existing indirect tax regime. Currently, the plan under the GST is that all of these will go away, and there will be one common uniform service tax regime. So, for example, you have currently a situation where if you are selling goods within the state, so if you're buying raw material from within the state, and you will have to pay what is called value-added tax. Whereas if you are buying raw materials from a second state, so for example, if you are based out of Maharashtra and you are buying raw material from, say, Madhya Pradesh, then you have to pay central sales tax, which is different from VAT. And the issue with that is that some of that cannot be, you cannot claim credit for some of that. And that is what we will now get into to understand a little better. We have created an example of a car manufacturer who is, who's buying raw materials, some of which is from within his own state, some of which is from another state, and some of which is actually imported from outside of India. Just to give you an example and explain to you how this whole existing situation works out. What we will do is we'll use the same example subsequently to explain how the situation will change when the goods and services tax regime comes into play, probably from the 1st of April 2017. So, Raman, if you can take us through this example.
Yeah. In the above example, we have depicted the present tax structure. There is a car manufacturer based in Gujarat. On the left hand side of the screen is the value of raw material components which he has purchased from other manufacturers, and on the right hand slide on the right hand portion of the slide there is a supply chain process. The manufacturer has sold the goods to distributor, and the distributor has sold the goods to the ultimate consumers. So let us come into the purchase part of the manufacturer. The manufacturer based in Gujarat has purchased some steel from a steel plant based in Gujarat. So we have assumed the cost of the goods as 30 lakhs. Excise duty, since this is a manufacturer based in Gujarat, so he levied excise duty at rate of 12.5%. The figures comes to 3.75. Now VAT is again leviable on the cost plus excise duty portion, and the VAT amount will come to 4.73. So the total billing amount includes the cost of manufactured goods for steel plant and the excise duty in the excise duty, the VAT will also further be leviable. So the total cost of total billing amount for the car manufacturer in this case is 38.48. Excise duty come into picture because the steel plant has manufactured goods, and the VAT has come into picture because there is a transaction with respect to sale of goods within the same state. Car manufacturer is also based in Gujarat, and the steel plant is also based in Gujarat. Now, the car manufacturer has taken tires for his manufacturing process and all, for which the cost of the tire is 20 lakhs. The excise duty against this year manufacturing plant to excise duty levied is again 12.5%, is 2.5. And since this is a sale of goods from one state to another state, and central sales tax come into picture. In this case, we have assumed central sales tax to be at the rate of 2%, so it comes to 0.45. So the total billing amount, including excise duty and CST for the manufacturer, is 22.95 lakhs. Now, since this is a sale of goods from one state to another state, that is from outside Gujarat to Gujarat. So, in case of Gujarat, as we all know that entry tax is also leviable. So, entry tax is a tax which is not charged by the seller in his bill. However, this has to be borne separately by the purchaser, and this has to be deposited directly into the government account by the purchaser. So entry tax again has to be borne by the car manufacturer in this case, that is 0.46 lakhs. The car manufacturer has further made an import of certain engines. The import value here in this case is assumed as 100. The basic custom duty is 10% of the total import value, which comes to 10. Again, we all know that with the implementation of GST, basic custom duty will not be replaced. With the implementation of duty, only the duties which are covered under custom tariff act, for example, central countervailing duty and special additional duty, CVD SAD, which we call it as, which will be subsumed post implementation of GST. So in this case, CST, which is levied presently, is 13.75 lakhs, and the special additional duty is 4.95 lakhs. So the total purchase price for the manufacturer is 128.70 lakhs after adding the basic custom duty and other additional duty of customs. Now, in this case, if we have to calculate the purchase price, the base price for a car manufacturer, the base price for a car manufacturer, since he is manufacturing goods, so he'll be able to take the excise duty which has been paid on the purchase of goods, and the VAT that has also been paid, he will be eligible for credit of the same. However, in case of CST, since he is input, in case of CST for a manufacturer, there will be an input CST for manufacturer, for which that is basically a cost. So he'll not be able to take the credit of.
Just to since we are dealing with non-finance professionals, just to clarify, so what's happening is, for all the raw materials that are being bought by the car manufacturer for the process of actually manufacturing the car, for some of these duties that are being paid by the car manufacturer, he can set it off against and therefore seek credit for when he in turn is selling those cars to distributors or any other third parties. So for example, to Raman's point, the excise duty that he has paid for the steel, for the buying of the purchase of steel, the VAT that he has paid on top of that, the excise duty that he has paid for the manufacture of tires, all of these he can claim under the current regime as claim credit for. Whereas, for example, on the CST, that 2% CST that he has paid for the tires, or the 10% basic customs duty that he has paid for the import of certain, say for example, engines, these are not things that he can seek credit for. So effectively, and also for example, the entry tax that they have to pay, and most states in this country have entry tax in some form or the other. All of these are costs at the hand of the purchaser, which needs to be deposited directly with the government. So essentially, there is no credit available. As a result of this, the overall cost of manufacture goes up, because some of these costs, as you can see, have to be borne by the end manufacturer, which in this case is the car manufacturer, and cannot be taken credit for. So the overall cost goes up, and we will see how, in case of GST, some of that is going to change, and therefore we will be able to get certain additional benefits under the GST regime. But we'll come to that in a minute. So, for example, in this case, for steel, for the tire, as well as for some of the additional duties on top of customs, there are certain credits that can be received. We now move to the part where the manufacturer has manufactured. There are two situations we have considered. One is a situation where the manufacturer manufactures the car and sells it to a distributor within Gujarat. And then we've also considered another situation where the manufacturer in Gujarat sells his cars to a distributor in Madhya Pradesh. And Raman will now explain how these sort of situations will change.
Yeah, in the first scenario, for sale of car from Gujarat to within the same state, the manufacturer has paid the basic price of 160.91, which comes after taking the relevant grade which we have just discussed, and after adding, of course, the CST part, entry tax part, and the basic custom duty to the cost of the manufacturer. Now, in the above example, we have assumed that the manufacturer has made a further value addition and profit margin of 30 lakhs. So the excise duty that is leviable on the by the manufacturer includes on the basic price and on the value addition and the profit margin part, so which comes to 23.86. So on the left hand side, there is an excise duty output of 23.86 lakhs for a manufacturer, and he has already paid the excise duty input at the time of purchase. So he'll be able to set off the input which he has paid at the time of purchase. So the net amount payable for the manufacturer is 17.61 only, after setting off of the excise duty input which he has paid at the time of purchase of goods. Similarly, VAT is leviable on the basic price plus value addition and profit, including excise duty, which comes to 30 lakhs approx. So this is the output VAT for a manufacturer. So he'll be able to claim the input VAT which he has paid at the time of purchase of goods, at the time of purchase of steel from a local from within the state, that is Gujarat. However, in case of purchase of goods from outside Gujarat, that is CST is levied, so he will not be able to claim the input tax credit for CST, which is basically a cost for a car manufacturer. So let us come into the second scenario, in which the car manufacturer based in Gujarat has sold goods to a distributor based in Madhya Pradesh. in this case, the basic price will remain same, 160.91 as we have discussed. The value addition and profit margin will also remain same. The excise duty which is charged by him is 12.5%, which is similar to the above example, because there is no difference with respect to the excise duty part, whether you are selling the goods from within the same state or from one state to another. So the net excise duty that is payable by the manufacturer will also remain same in this case. However, since this is a sale of goods from one state to another state, manufacturer is selling goods from Gujarat to a distributor in Madhya Pradesh. So in this case, CST will be levied. So, as you may be aware that in case of output CST, we can claim the input VAT that is paid at the time of purchase of goods. So, in this case, no CST will be payable by the manufacturer to the sales tax department. So, the total sales price to the distributor in this case, after adding the basic purchase price, then the value addition, profit margin, excise duty, and CST comes to 219 lakhs approx. However, since this is a transaction of sale of goods from one place to another place, that is from Gujarat to Madhya Pradesh. So the manufacturer based in car manufacturer based in Gujarat will not levy any excise, will not levy any entry tax in his invoice. However, in case of Madhya Pradesh, entry tax will come into picture. So the distributor will have to bond the entry tax of 2% of the value of goods that he has purchased, which comes to 4.38 lakhs in this case. So the total cost to distributor is 223.45 lakhs in this case.
So essentially what's happening is that for some of these taxes, there is a chain which can be seen. So there is excise duty which is being charged on the manufacturer, and their credit can be taken for excise duty that has already been paid by the manufacturer. But then there are taxes, for example, like the entry tax that we saw in two situations, where there is no tax which is levied by the manufacturer or the seller, but has to be paid at the point of entry by the buyer, and as a result of that, that gets added to the cost, which cannot then be transferred out. There is no way of seeking credit for. So both in case of the tire manufacturer selling to the car manufacturer, as well as the car manufacturer selling to the distributor outside the state, there are entry taxes which we saw were being levied, which gets added to the cost of the end product without actually being in any way being available for credit.
Now, yeah, in the first scenario, manufacturer has sold the goods locally to a distributor. So the distributor has further sold the goods to ultimate consumer based in Gujarat only. So the basic price for a distributor is 214.77, which comes from 160.91 is the basic price for a manufacturer. Then 30 is the value addition and profit margin. And in this case, since distributor is not engaged in the manufacturing process, so excise duty is again a cost for the distributor. However, in case of VAT, he will be able to set off his input VAT that is paid at the time of purchase from his output tax, output VAT liability. So in this case, the basic price for a car manufacturer is 214.77. The value addition and profit margin is 20 lakhs. The VAT that is payable on the based on the basic price and value addition profit margin comes to 32.87. So the total sales price to the consumer after adding all the three components of the invoice, basic price, value addition, profit margin, and VAT, comes to 267.64. However, the distributor based in Gujarat has to can set off the input VAT that he has paid at the time of purchase of car. So the net VAT payable in this case is 2.8 lakhs. So since he is not a car manufacturer, so excise duty is basically a cost for him. Similarly, in the second scenario, the distributor based in Gujarat has sold goods to the consumer. The distributor based in Madhya Pradesh, has sold goods to consumer based in Madhya Pradesh. So the basic price in this case has been increased. That is 223.45. This has been increased predominantly because of the fact that CST is levied in case of sale of goods from Gujarat to Madhya Pradesh, which is again a cost for the distributor based in Madhya Pradesh, and the entry tax is also required to be borne by him. So the cost of goods has been increased by distributor based in Madhya Pradesh. Cost of goods basic price comes to 223.45. He has made a value addition plus profit margin of 20 lakhs, and since this is a local sale, so in this case the distributor will levy VAT to consumer. Total sale price which has to be borne by consumer in Madhya Pradesh is after adding the basic price, value addition and VAT. However, the distributor maize in Madhya Pradesh will have to bear the entire output VAT liability of 34.08 lakhs in this case, because since he has made a purchase of goods from outside state on which CST is levied, so no credit is available in respect of CST paid at the time of purchase. So the entire VAT output which is levied by distributor to ultimate consumer uh, has to be deposited by the distributor to the government account.
So what we can see quite clearly is, and this is something that all of us experience in our day-to-day lives as well, is for the same product manufactured from the same location, if you are based in different states, the end price that you have to pay is different. So in some cases, for example, in Maharashtra, especially in Bombay, because of certain taxes like the octroi duty, the price of a car is significantly higher than, say, in Delhi or in some other parts of the country. Even if it is, so even if you're buying a car from Maruti, which is manufactured from in Haryana, depending on which state it is eventually being sold at, there is a significant cost differential, which is not just because of the cost of transport, but also because of these various taxes and the way they play out depending on whether they are being bought within a state or outside a state, the entry tax being levied in an individual state, whether a tax can be taken credit for or not. So all of that makes the current situation very varying across the country, but also more importantly, it becomes difficult because think of a small and medium enterprise, the number of different registrations that they have to take depending on the states in which they are operating, the number of taxes that they need to consider, the amount of information that they need to keep with themselves to be able to do business in a compliant manner is very high, and it makes it extremely difficult from a compliance perspective to keep track of all of these different things. Of course, we just took an example where there was no service tax additionally involved. In certain types of businesses, for example, if you are providing partially, for example, in interior designing or in some other, some other businesses where simultaneously both VAT as well as service tax gets levied, which makes it even more complicated. However, we will, for the interest of this presentation, stick to this example. And I know that we are just constantly talking. So while we will now move on to the next slide, Mr. Rao, if you want, what we can do is take a minute now to see if there are any specific queries with regard to the existing tax structure before we move into what is the proposed indirect tax structure, which is the GST. Mr. Rao, if you want, we can stop for a minute and do that. Mr. Rao, are you there? Okay, so we will continue with the revised tax structure, which is where, like we discussed, some of the existing taxes are going to get subsumed or are going to be replaced by one common tax regime, which is the GST. Raman, if you can please explain to us.
With the proposed indirect tax structure in India, GST will be there. So, as we all know, GST is a tax which is leviable on the supply of goods and services, and for which a continuous chain of benefits is available from the manufacturer's level up to the retailer's level. Of course, this GST is also required to be borne by the ultimate consumer. So, in case of GST, this has been segregated into two parts. One is transaction within the same state, and another is transaction from one state to another. So with respect to transaction within the same state, we usually call it as intra-state. So there are two types of taxes which will be levied. One is the CGST that we call as central GST, and the another one is the SGST. We call it as the state GST. Central GST, as the name suggests, will be levied by the central government, and state GST will be levied by the state government. Central GST and state GST will be levied simultaneously on sale of all goods and services within the same state. Now, with respect to sale of goods, supply of goods and services from one state to another, we call it as a inter-state transaction. So, in this case, IGST will come into picture. IGST stands for Integrated Goods and Service Tax, which will again be levied by the central government. However, there are certain taxes which is still proposed to be excluded under the purview of the GST Act, which includes basic custom duty. Since we have discussed in the first slide that basic custom duty will still remain, only the additional duty of custom, for example, countervailing duty and special additional duty will be replaced post implementation of GST. Now the stamp duty will also be there. All the taxes which is levied by the local bodies, tax on petroleum products, tax on alcoholic liquor for human consumption. There is a debate also going on with respect to tax on tobacco products. Tax on tobacco products will come under the purview of GST. However, the central government has the power that they may levy excise duty also on the tobacco and tobacco products. So there may be an impact of double taxation also for the particular variety of products. So let's come to the taxability impact of the proposed GST. GST is proposed to be levied and collected on. We have segregated for the purpose of simplicity. We have segregated the things into three parts. One is the supply of goods and services in India. Second one is the importation of goods into India, and third one is the importation of service. Now coming back to the supply of goods and services in India, there may be two different kind of transactions. One may be a transaction within the same state that we call it as a intra-state supply, and the another one is a transaction of between one state to another state. We call it as a interstate supply. As we have discussed, for interstate supply, central government and state government both will levy GST simultaneously, which we call it as a CGST and SGST. And with respect to the supply of goods and services from one state to another, IGST will be levied, which is again be levied by the central government. IGST rate would roughly be equal to SGST plus CGST. So with respect to the importation of goods into India, presently as we have discussed in our example, in case of importation of goods, basic custom duty is levied, countervailing duty is levied, and special additional duty is levied. Now with the implementation of GST, in case of import of goods, basic custom duty will be there, since basic custom duty will not be replaced post implementation of GST. The additional duty of custom, for example, countervailing duty and special additional duty, that will be replaced by IGST. And in case of import of services, obviously IGST will be levied. So in case of export of goods and services, GST will not levy any tax. That's why we call it as they are considered as a zero rated supply. So no tax will be levied in case of supply of goods and services outside India under the purview of GST. So the example which we have just discussed some slide before, workflow with respect to the present tax structure. Now we have considered the same figures and just calculated the tax impact and the effective tax rate based on the proposed tax structure under GST. In the previous example, the cost and all are same. The cost is 30 lakhs. The manufacturer, again, the left hand side of the slide is the goods that manufacturer has purchased, and on the right hand side of the page is the supply chain process for manufacturer to distributor and from distributor to ultimate consumer. So let's come into the purchase aspect of the manufacturer. Manufacturer based in Gujarat has purchased steel from a supplier based in Gujarat. The cost of the steel is 30 lakhs. In this case, GST will be levied after the implementation of GST. So GST will be levied. For the purpose of this example, we have considered the GST rate as in the range of 18%.
So what we just need to quickly also understand is that what is happening with GST is that these rates which are now varying between state to state. So the VAT rates are different in most states, and as a result of which the overall tax that a product has to be has to face depending on where it is being manufactured, where it is being transferred, varies from one state to the other. Whereas what is happening currently is under the GST regime, the proposition is that there will be a few slabs with a revenue neutral rate, which is still to be fixed. There is a meeting on 30th of September of the GST Council where there is a possibility of the revenue neutral rate being fixed at somewhere in the range of 18%, which is what we have considered. But then there will be one set of goods for which that the rate will be probably closer to the 4 to 6%. Then there will be another set of goods for which it will be in the 12 to 14%. And then there will be one set which will be like the luxury goods, which will probably be closer to the 30+%. Now, in that situation, what's going to happen is, irrespective of which state this is being manufactured in, which state it is being transferred to, depending on which slab the product falls within or the service falls within, there will be one uniform tax, which is, if it is 18%, then 18% across the board, irrespective of which state this is being manufactured or where it is being transferred, as opposed to the existing situation where the VAT, etc., keep changing from state to state. So, and of course, with the repeal of things like entry tax, octroi, all of those additional burdens which vary from state to state are also going to go away completely, as a result of which there will be one uniform tax regime. So like we can see with regard to manufacture of steel, if it is being manufactured in Gujarat, there will be a fix, so the excise duty goes away. If the GST is say 18%, then it is one number which you will know, irrespective of whether it is in Gujarat or Maharashtra or any other state. This will remain exactly the same. So the billing amount will be the same, irrespective of which state it is being manufactured in. The same with the tire. So if you remember in the previous example, since the tire plant was outside of Gujarat, instead of GST, a central sales tax was being charged in that case, and therefore it would vary again. And there was also an entry tax for the goods to be transferred from outside Gujarat to within Gujarat, which also goes away. And then, of course, similarly with regard to customs, the basic customs duty, of course, remains, but all the other taxes that were there are gone, and therefore there is a uniform taxation regime which will come across. And now, if you see, fundamentally there will be no change if a good is manufactured in Gujarat and then sold within Gujarat or sold outside Gujarat, and Raman will explain that in greater detail.
Yeah, so car manufacturer purchase steel from a steel manufacturer based in Gujarat. So in this case, the cost of the goods will be 30 lakhs, as we have considered in the previous example also. So in the previous example, in the present scenario, for a steel, for any manufacturer, excise duty and VAT is levied in case of sale of goods within the same state. So excise duty and VAT both will be subsumed, and GST will come into picture. So the GST rate is 18% in this case. So the billing amount will be cost plus GST. So the entire taxation structure, for example, presently there are various kinds of taxes. Excise duty, VAT, CST, Entry Tax, all will be replaced, and there will be a single tax that we call it as a GST, for which there will be a seamless flow of credit from the manufacturer level up to the retailers level, irrespective of the states. In case of sale of goods from one state to another state, then also the manufacturer or the trader will be able to take the credit. Similarly, in the case of the within the state transaction. So in the second case, the manufacturer based in Gujarat has purchased tires from a tire manufacturer outside Gujarat. So the cost of the goods is 20 lakhs. Since this is a transaction from one state to another state, that is interstate sale of goods, so the IGST come into picture. IGST, we call it as integrated goods and service tax, which is leviable on the sale of goods from one state to another state. So the total billing amount in this case is, after adding the IGST part, is 23.60 lakhs. Similarly, if the car manufacturer is importing certain engine from outside India, so the import value is 100. Basic custom duty, as we have discussed, will remain same post implementation of GST. So it will be remain same as a GST, which will again be a cost for the manufacturer. This will be added in the cost price only, because there is no credit available against the basic custom duty that is imposed on the purchase of, on the import of goods. And then in case of in the GST regime, since this is a outside state transaction, so IGST come into picture. The rate will remain same. So the total sale purchase price for a car manufacturer after adding the import duty, basic custom duty, and IGST is 129.80. Now, if we will refer the basic price in the in the first scenario, the manufacturer based in Gujarat has sold goods to a distributor based in Gujarat. If you will refer the basic price, it will come to 160. How the figure 160 is arrived? Still he has purchased for 30 lakhs, tire for 20, because GST, IGST credit all will be available. Only in case of import of goods, basic custom duty will form part of purchase. Hence, the imported value of goods is 110 for car manufacturer. So the total basic price comes to 160 lakhs. Now he has added certain value addition and profit margin of 30 lakhs. So the GST that is payable by him is 34.20 lakhs. On the basic price and value addition part, after adding the GST component, the total sale price uh, to be charged by distributor is 224.20 lakhs. In the present scenario, GST charged by manufacturer is 34.20 lakhs, and the GST paid by manufacturer on the purchase of goods, whether within Gujarat from a steel manufacturer, outside Gujarat from a tire plant, or import of goods, credit will be available. So in case he'll be able to take the credit of GST which he has paid at the time of purchase of goods. If we'll add all the three, and then it is coming at 28.80 lakhs. So the net GST payable by the manufacturer is only 5.40 lakhs in this case. Similarly, in case of in the second scenario, that is sale of goods by manufacturer based in Gujarat to distributor based in Madhya Pradesh, the basic price will remain same. A value addition and profit margin is 30 lakhs. In this case, since this is sale of goods from Gujarat to Madhya Pradesh, that is from one state to another, so IGST will be levied at the rate of 18%. So the figure comes to 34.20. So the total sale price to distributor after adding the basic price, value addition, IGST comes to 224.20 lakhs. The output GST which is payable by the manufacturer to the government is after adjusting the input GST which he has paid at the time of purchase of goods. Since we have seen here in the present scenario, entire GST that is paid at the time of purchase of goods, the manufacturer has been able to claim the credit. However, this is not the case in the present scenario. Excise duty is again a cost for a distributor. He will not be able to claim the credit.
So that is probably the biggest, distinction that we need to look at. That unlike in the current scenario where some of the indirect taxes cannot be, beyond the point, the credit is not available for them. So, for example, like Raman had mentioned in the earlier example, that with excise duty as well as with some of these entry taxes and octroys, they are not, credit is not available to the distributor or to the manufacturer in some cases for those duties that are paid, as a result of which they become additional costs, and the overall, and eventually, since indirect tax is eventually borne by the end user, which is people like us, the inevitable outcome of that is that the cost of the product goes up. Whereas in this case, since there is no distinction being made between excise duty, VAT, CST, or entry tax, and it's one common goods and services tax, the implication of that is that, there is all of the credits are available irrespective of whether it is an excise duty or whether it is VAT, and as a result of that, the overall cost at the hands of the end user is likely to get reduced in the eventual analysis.
So in case of in the first scenario, the manufacturer has sold the goods to the distributor based in Gujarat. So the distributor has further sold the goods to the ultimate consumer. The basic sales price in this case is 160 is the basic sale price for the manufacturer, and only value addition and profit margin portion is added to that. So in the previous example, the other prices is also added for which credit is not available, as we have already discussed. For example, CST, Entry Tax and all. This is not the case post implementation of GST. So the entire tax structure will become simpler post implementation of GST, and the cascading effect will also be removed, which is presently there. That is, VAT is leviable on the excise duty part also. Excise duty becomes the cost of purchase for the distributor. CST becomes the cost of purchase irrespective whether he is distributor, manufacturer, or ultimate consumer. Entry tax is again a cost of purchase. So these all the cascading effect of the taxes will be removed post implementation of GST. So in this case, the distributor has sold the goods to the ultimate consumer at a basic price of 190. He has further made a value addition and profit margin of 20 lakhs. So the GST that is charged by distributor to ultimate consumer in this case will be 37.80. So after adding all the components, basic price, value addition, profit margin and GST, the total sale price to consumer is in Gujarat is 247.80. However, the output GST that is to be paid by the distributor to the government is after setting off the input GST which he has paid at the time of purchase of goods. So only the net GST of 3.60 lakhs is required to be paid by the distributor to the government account. Now, with respect to the second scenario, the manufacturer based in Gujarat has sold goods to a distributor in Madhya Pradesh. The distributor in Madhya Pradesh has further sold the goods to the consumer within the same state. Basic price, sale price, basic purchase price will remain same. Value addition and profit margin will remain same, 20. GST will also remain same, 37.80. So the total sale price is same for the consumer in Gujarat and irrespective of the fact that the goods are manufactured in Gujarat or any other state. So this is the major difference between the GST and the other present taxes. That's why we also GST is also called as a destination based consumption tax. Tax is leviable at the at the time of destination. So if we refer the effective tax rate, the cost of goods is 200 for ultimate consumer and he has paid total taxes of 47.80. So the effective tax rate is only 24% in this case. Now 18% is the GST rate that we have considered in this example. So the further basic custom duty that has been 10 lakhs which the manufacturer has paid at the time of import of goods has been added to the cost of purchase. That's why the effective tax rate come into the range of 24% instead of the standard GST rate of 18%. Now the GST which we have assumed as 18%, obviously it includes both the central GST and state GST. So the central GST maybe will be in the range of 10% and the state GST may be in the range of 8% in case the GST rate will be 18%. And SGST and CGST will be levied simultaneously in case of sale of goods within the same state. So there is a huge tax difference between the present regime and the proposed tax structure under GST. The effective tax rate has gone above 30% in the present structure. It has gone up to 39% in case of consumer who has purchased the goods in Madhya Pradesh. So there will be a huge relief for the consumer for the purchase of any manufactured goods. However, for a consumer of any services also, that is not the case because the present service tax rate is 15%. Obviously, the basic rate is 14% and 1% is the cess, Swachh Bharat cess and Krishi Kalyan cess. So with the implementation of GST, the service, the SSC engaged in the supply of services, they will have to bear a higher tax burden of 18%.
That is the understanding as of now. Of course, the rates are yet to be officially announced, but the as we understand from our interactions with the departments as well as with various stakeholders, is that the chances are that if the RNR is fixed at around 80, revenue neutral rate is fixed at around 18%, then services will also be taxed at 18% generally. So therefore, for a number of different services, and we'll have to yet wait for the rules and get into the details of that. But as of now, it seems like it's possible that for some of the services, the tax will go up from the current 15% to closer to 18 to 20%. And since these services could be anything from airline tickets to railway tickets to restaurant bills, there is a possibility that in the shorter term, the cost of an individual with regard to services will increase, and there is some speculation that this might even lead to a shorter term increase in the overall inflation rate of the country. So these are discussions which are still it's still probably a little theoretical, but we will see how it pans out as the rules get finalized.
So since we have discussed the GST and its components, so GST, as we have discussed, is the tax on goods and services with comprehensive and continuous chain of set off of benefit from the producer's point up to the retailer's level. and GST will have two different components. One will be levied by the central government, that we call it as a central GST. Another one is levied by the state government, we call it as a state GST. In case of sale of supply of goods and services in the same state, both central GST and state GST will come into picture. However, in case of supply of goods and services from one state to another, IGST will come into picture. IGST stands for Integrated Goods and Service Tax. The rate of IGST would roughly be equal to CGST plus SGST. We have already discussed a broader example of supply chain stage of supply chain from manufacturer to distributor and to ultimate consumer. So in the interest of time, I am skipping this example. So this is the mechanism of GST as we have discussed. The manufacturer will claim back GST which he has paid at the time of purchase of goods or services. Manufacturer will supply goods and services to wholesaler. Wholesaler will again claim back the GST paid on purchase of goods and services. Retailer will also claim back the GST paid on goods and services which he has paid at the time of purchase to the wholesaler. And the ultimate GST will have to be borne by the ultimate consumer. This is a manner of the credit of input credit set off in GST. In the previous example of the proposed tax structure on the GST, we have assumed we have taken IGST and SGST. So and we have set off the credit from one from another. There is some restrictions with respect to the set off of credit between the IGST, CGST, and SGST. So in case of IGST, since this is a tax will be levied by a central government on entire supply of goods and services, so IGST will be first set off against the IGST. There is we have also taken an example for the purpose of simplicity. The output IGST in this case suppose is 100. So this will at first be adjusted against the input IGST of rupees 50. Then balance remain, if any output is remain, then it will be further added against the further input GST of rupees 20. Then also if any balance remains, then the input SGST of rupees 10 can also be adjusted. So the net IGST payable by the SSE will be after adjusting all the set of benefit which is allowed under the proposed GST regime. In case of CGST, this can be set off only against the CGST and IGST only, and similar is the case with SGST, which can be set off only with SGST and IGST. So from the above scenario, it is clear that the CGST cannot be set off against SGST and vice versa also. This is a snapshot of the present tax structure versus a proposed tax structure. We have already covered this at the time of example. So this is a most important slide. This is a recent progress on GST and the way forward. Recently, there is lots of progress on GST over the last 3 to 4 weeks. The constitutional amendment bill has also been passed by Parliament. The states have ratified, more than 50% of the states have ratified the proposed GST bill. President has also given the assent, and the Cabinet has also given the approval for formation of GST Council. So GST Council is presently in place. One meeting has already gone. The second meeting is scheduled to happen on the 30th of September. On the first meeting, they have decided certain things. For example, for a supplier of goods and services for a turnover of up to 1.5 crore, that is to be controlled by the state government. With respect to the service SSEs who are covered under the present service tax regime, since the state government doesn't have any expertise to regulate the service tax SSE, that's why this has been decided that service tax SSEs can be controlled by the central government as it is done in the present scenario. And the most important point is the threshold limit. For the registration, the threshold limit is 9 lakhs for other states and 4 lakhs for northeastern states. However, for the threshold limit for payment of tax, this has been increased by the GST Council to 20 lakhs for the other states and 10 lakhs for the northeastern states. So after the model GST law, GST Council will have to frame all the rules, regulations. Then Cabinet approval is required for the CGST and IGST laws to be levied by the central, and SGST law to be levied by the state. Then all the GST rules will also have to be notified, and most importantly, the IT infrastructure is required to be prepared. So GST network will be the infrastructure for the users for a proposed GST regime. And post that GST, it seems that with the kind of progress that government has made over the last 3 to 4 weeks, it seems that GST will be potentially implemented by 1st April 2017.
So some of the decisions that have already been taken are fairly significant. For example, as Raman was saying, that the threshold limits have been set at 20 lakhs for all states except the northeastern states, which means that anybody with revenue of more than 20 lakhs per annum will get covered by the GST regime and will have to take a registration under the GST regime. This has a short term or at least an impact on some manufacturers who earlier used to opt out of the excise duty regime, and that was allowed. You could opt out till a revenue of 1.5 crores per annum. So suddenly, that for that set of people who were taking that option of opting out of excise duty at a revenue of less than 1.5 crores, that option does not exist anymore, and they will have to get covered by GST. So therefore, there will be an impact of that on the MSMEs, at least in the short term. The other important aspect from an MSME perspective, particularly, is the fact that unlike in the current scenario, where if you had deducted VAT and then paid VAT, you could claim credit if you had already paid VAT on a particular item and then you wanted to deduct. You could claim credit irrespective of whether people down the value chain, up or down the value chain, had deposited VAT with the. I'm sorry, for with regard to excise duty, you could, my mistake. For excise duty, you could, irrespective of whether the person you had bought from had deposited their excise duty or not, as long as you had deducted, you could seek credit. Unlike in the current situation where you will only be able to seek credit if people down the value chain have also deposited the GST that they had deducted. So that will mean that if if you are a part of a value chain which includes large manufacturers, the option of not registering and not depositing the GST is not there, because the large companies will definitely insist on only doing business with people who are depositing their GST on time, because without that they will not be able to seek credit. So the way some of the MSMEs do business will have to change quite a bit to be able to cater to the GST regime. Also, as Raman was talking about, the whole thing will be through the GST network, which will be online. So people who are currently not using the internet or not registering online, especially with the reduced threshold of 20 lakhs, the number of businesses which will now get covered will significantly increase. And we know that a lot of these companies or a lot of these businesses are currently working on an almost pure cash arrangement, where they don't register, don't have a code either for service tax or for VAT, as a result of which they're completely out of the taxation regime. That will probably become more difficult now, and they will have to register, and therefore it is probably a good idea to start taking this seriously from now and start planning for the implementation of GST, because it will be far more difficult, because of the reasons that we just talked about, to stay outside of the indirect tax regime like a lot of businesses are doing currently.
So, with respect to the registration part, for the purpose of simplicity, we have bifurcated the same for the existing taxpayer and the new taxpayer. For the existing taxpayer, the question that is coming to our mind is, do all SSC dealers who are already registered will have to obtain fresh registration or not on the GST? The answer is no. The every SSC who is already registered under any of the earlier law will be issued a certificate of registration on a provisional basis in such form and manner as may be prescribed. The certificate of registration which will be issued shall be valid for a period of 6 months, which will be further extended based on certain documents and on the recommendation of the respective governments. Every person to whom a certificate of registration has been issued will be required to furnish certain details to a satisfaction of the government. And most important things that will come post implementation of GST for the service tax SSC who have taken centralized registration. Since in case of GST, all the states registration is required to be taken separately in respect to all the states. So the service tax SSC who are maintaining centralized registration presently will have to apply afresh in respect of all the states for which they are presently dealing. For a new customer, we have already discussed for new taxpayer, the registered limit is 9 lakhs for the other states and 4 lakhs for the northeastern states. This is a mandatory limit, mandatory registration. Once applied, the time limit is 30 days. Within the 30 days, the registration will be granted, and within 30 days he has to apply for registration. Registration will be granted in 3 days. There are certain category of persons who is liable to be registered under GST irrespective of the turnover, which includes the person who are making any interstate taxable supply. Now with the implementation of GST, the another important change that will take place is in case of stock transfer of goods from one place to another within the same company, there is no taxes levied. So, with the implementation of GST, taxes will be levied in case of stock transfer of goods from one state to another state, and within the same state, the taxes may be levied based on the registration. If the SSC has registered separately for within the for the same state, and if he is making any any stock transfer from one place to another, then also he is liable to charge GST, and the receiving branch will have to bond GST.
And this is again quite significant because the GST will have to be deposited as soon as the stock transfer has happened. So as a result of that, what is inevitably going to happen is that there will, and while they will eventually be able to hopefully seek credit, there will be an inevitable short-term reduction in cash flow because of the money that will have to be deposited prior to the use of that good. So what will happen is, unlike in the current scenario where there is no such tax which is payable, there will suddenly be this additional burden which will have to be borne by by companies which are transferring stock between their own units, which is something which is extremely common. And this is something which is likely to impact small and medium businesses again. I mean, all businesses, but specifically small and medium businesses, the way it has currently been structured.
So there are certain returns which are liable to be filed under GST. Every registered dealer is required to file GST return. Filing of return can be made only through online mode. There will be a common return for CGST, SGST, and IGST. And in case of GST, as of now, there is no concept of revision of return. If a dealer is required to make any changes, then the changes is required to be done in the subsequent returns only. So 8 types of returns are prescribed in the GST. Normally, a standard SSC is required to file 37 returns in a particular year. 3 is for GSTR 1, 2, and 3. That is for outward supply for a particular month, inward supply for a particular month, and monthly return by 28th of the next month. Before filing the monthly return, taxes is required to be paid, because in case of GST, if no taxes is paid, you will not be liable. You will not be able to file your monthly return. And annual return is also required to be filed by 31st December of the next financial year. For compounding taxpayer, the quarterly return concept is there. For a non-resident taxpayer, the return is to be filed by 28th of the next month, and if he's surrendering the registration, then it has to be filed within 7 days of the expiry of registration. For input service distributor, also it has to be filed on monthly basis by 15. For person for which TDS is also liable, so it is required to be return is required to be filed by 10th of the next month. For the separate reconciliation statement is also required to be filed by those SSC who are liable to get their accounts audited by a chartered accountant. So this is the compliances for filing of returns. So these are the various advantages for of GST to various stakeholders. For business and industry, the compliance will become easy. There will be a uniform tax structure. As we have discussed, the cascading effect will be removed. For the consumer, there will be a single and transparent tax. As we have elaborated in our example, there will be a single tax from the manufacturer to the ultimate consumer. So the overall tax burden has been reduced. the effective tax rate in our example is 24% against the present tax rate of in the range of 30 to 35% on the present scenario. So for the central and state government, it is very simple and easy to administer since all will become under a single bracket. Presently, there are different departments for excise, different service tax, VAT, entry tax. So this will come under a single regime, and the revenue efficiency will also be increased with a better control on leakage. So for the overall economy, that there will be a transparent and better compliance. Corruption will also reduce to a certain extent because if the goods are purchased from the from a dealer who has not made the payment of tax, so the purchasing dealer will not be able to claim the input tax credit or so. Unorganized, more and more unorganized sector will also come into picture. This will
So
also
what is inevitably likely to happen, and obviously these are early days and we're still waiting for the whole all the rules to get formulated, and of course it is a completely different experience from what we have been used to for so many years, so it will take some time to settle in. But what is likely to happen in the medium term is we should see a lot of the cash transactions that happen currently getting significantly reduced. These people who are currently outside of the indirect tax purview because they have not registered themselves and seek money in cash will have to find ways of getting registered, because otherwise they will not be able to work with the larger entities. So if you're doing job work or doing any kind of work for any of the larger companies which can seek credit for the money that they're paying you by way of tax, they will not be able to work with people. Already we see that with regard to service tax. A lot of companies do not want to work with consultants who do not have a service tax registration. We will see that more and more happening with all the manufactured items as well. That a lot of the larger companies will not want to work with businesses which do not have a GST registration and who are not doing their GST filings on time. This has a direct impact on Make in India. As you know, a lot of these companies which are being asked to come to India and start manufacturing from here, they will absolutely not want to work with companies which want to do business in cash, which do not want to be a part of the GST value chain, and therefore we are fairly hopeful that as a result of the implementation of the GST Act, there will be a significant reduction in cash transactions in the medium term.
So there are major challenges which are required to be done before the implementation of GST. The revenue base of central and states along with the compensation requirement of center is required to be calculated. Some formula has already been discussed. For example, they can take financial year 15-16 as the base year, and they may take certain growth rate for a period of 5 years. Then GST rate structure is also required to be finalized, whether there is any items for which exemption will be allowed. Model GST bill or central and state government and all will have to form a consensus. Threshold limit, I think threshold limit part has been done by the GST Council. Still, this has to be finally approved. Then the GST network is required to be implemented. Then the extensive training is also required to be done in all the levels, whether from the point of view of the government department point of view, in the industry point of view. We all have to get ourselves educated, and extensive training and all is also required for the government official and for the workers, for the persons who are involved who will be involved in the day-to-day operations post implementation of GST. So these are the key terms and definitions which we have tried to cover during the course of our presentation. Aggregator, casual taxation person, input service distributor, revenue neutral rate we have discussed. This may be in the range of 18%. This is the rate which will allow the government to receive the same amount of money despite changing tax laws and all. So zero rated supply. In case of zero rated supply, no tax is payable. And however, there is a difference between a zero rated supply and the exempted supply. In case of zero rated supply, no input tax credit can be availed. However, this is not the case with respect to exempted supply. So this is a basic difference between the two. Then what is supply has also been defined, and the reverse charge. As we know, reverse charge is be borne by the person who has received the goods and services. Now, how Complify helps to increase business? We have a software called Complify, which we have developed for small and medium-sized enterprises. So, in the slide, you will be able to see there is a dashboard for 66% in green and 20% in red. 66% in green states that you have complied all your compliances within the due date. 66% you are compliant, and the 20% which is stating that you are not non-compliant. So software will give a update of how much compliant you are on a daily basis. And the 14% compliances are there which has not yet fallen due. For example, filing of income tax return or certain returns which are required to be filed on an annual basis. So as we have already discussed that in case of GST, suppose if one person is selling goods to another person, and the purchasing dealer has tried to claim the input tax credit paid on the purchase of goods, and the seller who has sold the goods has not filed his return and has not made the payment of GST. So the purchasing dealer will not be allowed to claim the benefit of IGST which he has paid at the time of purchasing of goods. So as a result of which, maybe more and more large enterprises and the enterprises which are more and more compliant may stop doing business with the enterprises who are less compliant. So through Complify, you will have a clear understanding of the compliances and all.
So what will happen also with Complify is with some of these larger. So what Complify does is it gives you all the compliances, not just for tax, of course. With the GST coming in, we'll have GST as well. We already have all the VAT, CST, and other indirect taxes mapped into Complify. So once you register yourself as a part of Complify, what will happen is you will start getting triggers to complete various compliances. And if you do them and upload your proofs of compliance, if a large manufacturer who's buying from you wants to check whether you are compliant for their transactions, you can just give them access to your Complify system, and they will be able to find out for themselves. It's a product that we have launched in conjunction with CII for its MSME members. So if any of you are interested in knowing more about it, do feel free to reach out to us. So with that, I think we have covered pretty much everything that we wanted to say. We'd be very happy to take any questions that you may have. Mr. Rao, over to you.